We're going to talk today. I'm going to focus you on how I like to use lower price options, options priced at a buck or less, which means that's $100 a contract or less to control 100 shares of stock. It really gets you some mega leverage and potential for huge winners. Obviously, not every trade's going to win, but the opportunity, especially in these markets over the last year plus, has been ideal for this type of a setup. This is a very easy pattern that I'll show you, kind of at least the core foundation of what's been about 3 decades in the making for me. I got started trading in 1990 after graduating from Duke University, made the classic early mistakes, and basically, had to quickly learn technical analysis to realize that it's a lot easier to follow what the charts tell you than what your own opinions might be when the market doesn't agree. So we want to be in tune with the market. A reminder as we get into it that, of course, everything that I share with you today is for your information and education only. Nothing that we talk about here should be considered a specific recommendation of buy or sell any particular investment. Of course, you know that you are solely responsible for your own investment decisions, and Big Trends and the staff aren't responsible for any trades you choose to make. Not all Big Trends products or services are going to be appropriate for all types of traders and investors. This is definitely one of the higher risk strategies, but with a lot bigger reward relative to the risk in my view. But definitely what I'm going to share with you is on the more aggressive growth end of the spectrum today. So keep that in mind. Big Trends doesn't provide any personalized financial, tax, or legal advice, so consult your tax advisor before you make any investment that might impact your unique tax situation. So, we call this approach grand slam options, and if you know anything about baseball, it's about you're at the plate here at the bottom and you're looking to frankly hit it out of the park so you can clear the bases. So we're not just looking for singles where we can get smaller gains. Typically our first target on half of our position is going to be a double, which I'll call a plus 100% up first target. That's going to be where we look to buy an option, sell half of it when we get up to 100%. If we get up to 200%, then we'll take another half of our remaining half, or a quarter of our original position. So the triple is actually a 200% gain on your winning positions when they hit up to that level. And then the last one, of course, clearing the bases, would be plus 300%, the quadruple, the four bagger, if you will, plus 300% is where we take our final piece of the position. So that's the clear the bases final target achieved when we get to that. So we're looking for these kind of bigger home runs. Grand slam, of course, is when you have the bases loaded, you hit a home run. It's a grand slam 4-run score at once. That has a huge impact on your portfolio. Let's face it, sometimes you can strike out with this too. So we're going to talk about how you have to manage that as well, and try to keep, when it's not working, how we keep our losses down based on our time stops. Now we'll talk about this technique called gamma, which we're using a higher gamma approach with this to really get that kind of extra leverage. We'll talk about some of my favorite tools that I like to use, like the Commodity Channel Index or CCI, my Big Trends bands, and the average directional movement, the ADX, and review my overall review and case studies of my aggressive option strategy. Now, when you look at this equity curve, it's funny because, in 2017, when this is basically from the start of last year, we're going up month after month after month. And then we came down right here in September, and everybody said, oh, there's the top, things are, we're good for a while, but now, they're worried when I showed them that. And I was like, look, I'm just following the system. We're going to have the occasional losing month. The reality is you can see that it's been pretty much vertical, especially in December and January. And so it's about taking advantage of that. We'll show you some more examples of that. But the way that this works is that, like when we had Microsoft giving us a signal, I'll walk you through these indicators. We've got the % R on the second panel. We've got the CCI on the third panel in yellow. And then the ADX was the one that came on a little bit later. So we need all three of those to come on, and then we need it to close above those levels. You see it actually closed above there by just the slightest amount of Microsoft. Mid-October, we were buying into Microsoft. When the stock was trading about 76.5, we were buying into the Microsoft November 80 calls, about 5 weeks away till expiration. We usually buy them about a month out, give or take. And our first target on a double was in about 6 trading days. And so we bought these, by the way, for 55 cents. That's $55 to control 100 shares of stock in Microsoft, worth at the time. You can see about $7,600. So of course, you're paying less than 1% of the stock price. That's going to be more than 100-to-1 leverage. And we're able to get that double on a fairly small move where the stock moves up about 2 points or maybe 3%. We get the first target at 100%. But the home run for us came, we wrote it into earnings, because the only way I'll write a trade into earnings is if we actually have our double on half our position. What that means is when you double half your position, you get your risk capital back in your pocket. This gives you incredible freedom to be able to free roll, as I call it, on the rest of the trade. That, you know, it's a free trade. Even if the other side goes to nothing, you're still breaking even. All the examples I show you, of course, are before commissions, so factor your commissions accordingly. So, you know, in the perspective here that, and I see my lead consultant, Chris Sayers, in with me, so I hope Renee doesn't mind. I like to upgrade Chris so he can answer some questions from our attendees here. Maybe Renee can do that for me. Chris Sayre at bigtrends.com is his name there. Basically, the premise here is that, you know, when we get that free roll opportunity, you see the stock kind of flattened out right before earnings. It was still bullish on all of our indications, so we held it, and the stock finished that day right before earnings under $79. It opened at $84.30. So when it opened at $84.30, we were selling out of those 80 strike calls. By definition, you've got a right to buy the stock at 80. It theoretically wasn't worth anything below 80. Now it's up to 84.3. So if you're new to options, that means that it's at least worth the 4.3 points. That's called the intrinsic value. We sold it out at 4.71 right off the open, and that from 0.55 to 4.71 was a 756% gain on the second half, because we never got our 200 or 300% gain, but on the windfall gap in our favor, we take it all the rest off if it gaps past our targets. So you can see in this case that kind of a gain, when you think about that, they're not going to happen, you know, as often as we would like, but we can still make 100, 200, and 300 fairly good regularity. But when you get that kind of gain, think about that. That's averaging a 428% gain on the trade. Even if you're only putting in, say, 10% of your capital off of the capital you allocate to the Grand Slam option service, which we say if you start with 10 grand, you might put $1,000 in a trade. Well, $1,000 in this case, we're saying would have turned into over 5 grand. You know, so you're making 4 grand plus. That's your 400% plus return on your initial investment. So when you get that kind of a gain on a $10,000 account, you think about it, you're making over 4 grand. You're basically adding a quick 42% annualized on your portfolio on one trade. Okay, so that can make your year literally on one trade. So then it's just about managing risk as we go through the process. Now, when we look back through all the closed months, we're not quite closed with February, so this is just showing you through the end of January of 2018. You can see that 2017 obviously was a phenomenal year for this system, and we really had an even more phenomenal kickoff to the new year in January. That was our best month yet, and we're not even compounding these. We're still saying we're assuming you started with $1,000 a trade, model portfolio 10 grand. We have a lot of people that are doing it with more because they've been so happy, of course. But I always recommend, if you're coming into the service, and we'll give you a way to come in and try it for the next month here at the end of the presentation, I always recommend that you start small, and then you can always scale up once you see how well this strategy can work through all kinds of market environments, knowing that you're going to have the occasional red month. You saw September, a lot of people were kind of on the outside looking in saying, oh, let's say you just gave back your August gain, and saying, hey, guess what? You can have a rough month or 2 or 3. It can happen that you can go through a drawdown. We manage it, and I'll share with you how we manage it. We were pleased to gain it back and then some in October. We had a slight negative month in November. People say, oh, okay, well, you're going back and forth now. But then you see December was our best month of 2017, January our best month of 2018. Now, why is this strategy working? I believe a big reason is that volatility is still relatively low. You know, it had that little spike here earlier this month in February when we had that little quick 10% correction in the market. But even after that quick spike, you've seen the similar spike like that on the flash crash where we hit up around 50. We just recently here in February hit up to 50, and guess where we are now? We're back to like 17 or 16. So volatility can spike, but the reality is those are usually very short-lived events. When volatility is staying low and you're seeing the VIX trading in the neighborhood of the mid-teens, and you're getting stocks that are moving up, 30, 50, 100% annualized or more, you're able to buy relatively cheap options. I mentioned earlier that, with home runs comes strikeout risk. certainly when I think of home run leaders, I think of Babe Ruth, even though Hank Aaron broke his record in the 70s. The Babe hit 714 career home runs. At the same time, his strikeouts were almost double his home runs. And you think, well, how is that good? Well, because when you hit a home run, you clear the bases versus, you know, the times where you have to go back to the dugout after a strikeout. And the Babe won technically 7 World Series, but 6 that he played in, 4 with the Yankees, 2 with the Red Sox. I love how Babe says, never let the fear of striking out get in your way. That word fear is with a lot of you traders. That, you know, a lot of traders have what I call scar tissue that you've built up where you weren't doing things correctly, you got burned, and then you basically had to, you know, basically take a break or walk away in disgust. We don't want that. We want you to be able to take advantage of this and still manage the risk. Now, fundamentals matter too. I've got this scary gorilla on here. I call it the 800-pound gorilla because you want to know, you don't want to step in front of that thing. You want to be able to see where that gorilla wants to go and follow along at a close distance, safe distance behind. But essentially, the idea is that earning surprises are the thing that really drives, in my opinion, stock prices. It's not just the earnings themselves, it's the level of the surprise. If you get a big upside surprise, even if the news didn't seem like it was that good, if it's a positive reaction in the stock, that's something you want to go with and never fight it. So these big players are going to buy every dip in those strong positive surprises. They're going to sell every bounce in those negative surprises too. So you got to keep an eye on the earnings. I do that very closely. That'll get us in tune with where the big institutional money wants to go. That'll get you well fed and safely so over time. Also, it's another big opportunity to beat what I call the hole in the Black-Scholes options pricing model, and that's the fat tails of the distribution. See, the options pricing model assumes that, you know, more often than not, things are going to stay close to the current price, which is this zero deviation here. Shows about 40% of the time it's expected to stay around the current price. You can see that as you look out more than 2 deviations, it's saying that maybe only about 2.5 or 3% is supposed to be greater than a 2 deviation move. In actuality, the reality is that those 2 deviation moves are more like double that, about 6% on each side here. And more importantly, that the zero movement scenario is happening just over 30% of the time here. So the reality is that things don't stay static as much as the model expects, and you do get bigger trends. And you can see another way to look at it is that, you know, the 100-year flood is happening a lot more than once every 100 years. If you look at a typical 3 deviation move, which would be about a 3.5% loss on the downside, that's only expected to happen 27 times in 100 years in a normal distribution. In reality, it's flipped. It's happened over 100 times in just over 90 years. So from this perspective, the thought is, you know what, the stock market is not normal. It's what we would call log normal. And what that, just breaking it down simply, means is that you've got a big edge when you find trends that the market's not expecting. As you know, a lot of trends can exist a lot longer than you and I can predict they would last. That's what I've found in my nearly 30 years of trading, is that, you know, that's what we're playing off of as our big advantage as option traders. And so, you know, the first indicator we'll talk about is the Commodity Channel Index, the CCI. Donald Lambert developed this at the start of the 80s to really take advantage of futures and commodities trends, but I've shown it works on a lot of big name stocks. The interesting thing about the CCI calculation is that it shows you, you know, how far above or below the average you are in relative to the current price action. And it takes not just the closing data, and it factors in the highs and lows to create what Lambert called a typical price. That's going to give you more of a true sense of when something goes overbought in a bigger way. It tells you that there's really strong buying, and that's actually bullish if you get the proper setup. I'll show you more of that. And if it goes oversold, that means the institutions are dumping. If they keep dumping, it keeps breaking down, that's going to be actually bearish. You don't want to buy a market where institutions are dumping, getting rid of the stock, because they're like you and me. They want to be on things that are working, and they want to be off of things that are not working. Then Wells Wilder developed the ADX, average directional movement, and directional movement index, DMI lines, to show you the net new highs, net new lows, and in turn give us kind of a way to compare one stock to another, say how trending is that stock. We'll get into some examples of that, but then also my big trends bands is kind of a tweak on my friend Larry Williams's percent R, percent range indicator, or percent R usually is shown as bottom panel here, and you'll see percent R can stay over bot a lot longer than you or I would expect. So that's another good upside trend indicator. What my team and I did here at Big Trends is we said, you know what, we want to go see if there's another way to visualize that. So we create what we call the Big Trends bands, which means where's the likely 80th percentile retest going to happen when you get into a really strong uptrend. When you're breaking outside of that resistance, you can see for Baidu, things are really heating up. We were able to get those quick profits, 100, 200, 300% within 4 trading days. And let's show you the bigger chart here on Baidu. This includes all the indicators that I use. So when I'm looking at percent R setting up, it'll usually get there first. CCI is about a day behind it, so it needs to close above that. It does that next day. ADX in this case, the green line, we want to see that starting to trend up here and then break out above that resistance. So ADX got there first, percent R got there second, and CCI got there the day after third. So the pattern here is just that all 3 indicators have to be setting up as confirmed buy signals. 2 out of 3 is not acceptable. So I'm very picky about these setups that when you get that sort of rush into the stock like on Baidu, you want to be able to take advantage of that likely surge in momentum. So this is definitely momentum and trend trading based to say, where's the pressure going to be to pile on? Think about it. If you were bearish on Baidu and you're seeing this run to get in, do you want to be bearish through that? You're going to get blasted. You're going to literally get your head handed to you if you're not careful. So in addition to all the buyers coming in, the sellers are out there covering, and there's no natural sellers through those types of rallies usually as the stock's breaking the new highs especially. So you could see technically there's other ways you could have said the exit could have happened when percent R started to violate, which it didn't quite even violate here. ADX rolled over somewhere in this neighborhood. So you said, gee, why'd you sell it so early? Well, sometimes you'll see from some other examples, the 300% is kind of a termination point for some of these moves. So we don't want to be greedy. We want to be able to help people book profits gradually as the market makes money available to you. Now, for a lot of people who know the options pricing model, you talk about terms like delta, how fast your option is going to move on each 1 point move in the stock. Theta, of course, is something that matters to us because we've got to be careful about not getting a lot of time erosion. That's where my price stops and time stops kick in a short window. Vega I don't worry about so much because that's more of an implied volatility measure. That would be more of a factor if we were buying right in front of earnings. We don't do that. We buy plenty of time away from earnings or right after the earnings to make sure we don't have to overpay with that Vega effect. But gamma is what I'm talking about today, and that's how fast delta will be gained. So what this means is that usually a slightly out of the money option is going to have a fairly high gamma because as it goes from out of the money to in the money, you pick up a lot of deltas real quickly. So you go from kind of what people are thinking is a lower probability bet, somewhat out of the money, to a much better probability bet. And that means a lot of people get interested and you get a lot of opportunity there. Another example, this is Rand Gold, GOLD, one of my favorite gold names to trade. And this is back last late summer, late August, early September. You can see here's a case where the first time you see a couple of the indicators setting up look like ADX and percent R setting up, but CCI needed to get through that high right there. Didn't happen, and then backed off. So we wait, and then the next time it all comes together is right in here where you see this new buy signal on GOLD. We're buying about a 10 point out of the money, about 10% out of the money GOLD call going out into October. So again, here's where we've got maybe 6 or 7 weeks before the expiration. So we buy more time. You're going to have to go a little further out of the money to keep these option prices at $1 or less. And so in turn, 2 days later when it gapped up, it didn't just gap to 100% on the gap up, we got 160%. We still sell half our position there. We don't sell more or less because of that gap. And then we rode the next 200% target about 4 to 5 days after that. And then the 300% target hit right at the top. Now, sometimes that happens. It happened in December with our Southwest Airlines calls as well. That day was the termination day of the uptrend. Sometimes they keep going. Do I want to play that game? My experience is that, and talking with a lot of my Grand Slam subscribers, they like, hey, 300%, it's like the old phrase, bulls and bears can get rich, but hogs get slaughtered, let's not be piggish about this. So we do care about theta. This is the time decay chart. I've got a lot that I'm trying to cover with you here in this limited window. So I appreciate that you're with me on this rapid information session here. Typically, what I don't want to be at is in the last 2 weeks of expiration here, about 14 days before expiration. That's our mandatory exit on winning or other trades that aren't doing as well, that haven't broken down on our other time stop rules. We will be out 2 weeks before expiration no matter what. So if I had any other March positions that had value to close out at this Friday's close, I would get out, because this Friday, March 2nd, is 2 weeks before the March 16th expiration. I'm actually buying out into April now, so I don't have to worry about that. Okay, so we're buying out now more than 30 days. We're somewhere in this 40 to 45-day window here. And you see that our rate of time decay erosion typically in a 5-day window it's gradual. It's not dramatic, but it is there. It's more than it would be if we bought a 4-month option. So why don't we buy a 4-month option where the decay is more gradual? Because you will pay so much more premium, you won't get the kind of leverage potential to get these kind of big moves in relatively short order. So my rule is, if I bought something, say, 40 days away here, for example, if I'm not right on the stock 5 days in, at the 35th day, I would time stop myself out of the trade. Now, why don't we just use a price stop? Because with cheap options like this, you can get whipsawed if you use a 30, 40, 50% stop even. You can get knocked out briefly, and then it comes back within that 5-day window. So my rule is give it the 5 days. If we're wrong, that's enough of an uncle point to say there's enough time left to salvage a decent amount of value. Usually, unless it's gone hard against us over those 5 days, that can happen. And I tell people to expect it will happen. That's why you don't want to overcommit, even after the kind of impressive equity curve buildup that we've had in the last 13 months to 14 months. But bottom line is that here's an extreme gamma chart. If you're trading an option 1 day to go before expiration in red, I don't recommend that. You're buying at the money call on the morning of expiration when the stock's right at the money there at 50. You're going to have huge gamma. And that's attractive, but you're also going to have huge theta, huge time risk. So you've got to catch that strong trend move if you're buying them. If you're selling them and you're on the wrong side of it as a seller, you can also have gamma risk the other way, where basically that option picks up a lot of value against you. If you like to sell options with a day or two to go before expiration, be careful. That can be very risky. The better play is to buy 30 to 60 days out. We think with our timing, we're better off in the 30 to 40-day window usually, but essentially you see the 60-day option somewhere in the 49 to 49.5 range is the optimum gamma. You're going to pick up about, what that means, about, if it's 0.08 gamma, it means you're going to pick up about 8 deltas on the next point move up in the stock. So each successive point move in your favor, you're going to pick up some good delta. That means each point's worth more and more bang for your buck. As I mentioned, I'd shown people, we're not holding the remainder in this, of course, but I'd shown people live at the time that we had just booked our gain on Microsoft that I showed you earlier, and that we were riding the rest into expiration. I kind of put myself out there. It worked out. So, got a lot of new subscribers from that. But basically, you can see the kind of stocks that we like to trade here include a lot of the tech names. Alibaba, I've showed you, Baidu, Broadcom, of course, Microsoft I showed you. NVIDIA, a lot of people are talking about that as kind of a new age growth story in the semi-chip market for artificial intelligence, Bitcoin, et cetera. And then you see some of the oil and gold names, Schlumberger and GOLD, two of my favorites. A lot of the financials like Visa, MasterCard, Goldman Sachs, and then like casinos like Wynn Resorts and Las Vegas Sands. Just wherever we see opportunity. Of course, Tesla, one that often pops up. Tesla is an interesting case study because there's a good trade and a bad trade here on the left side of this chart, versus we see some cases where it shows a buy, but we did not get a CCI confirmation. We did not get an ADX confirmation. So 1 out of 3, not going to take that trade. But essentially, you see these first two were good to go. This first one, though, gapped up and didn't allow us to get filled. So we had to buy it on the first retest, which in this case, %R usually will give you your retest first. So we're buying in a little late compared to the buy signal you can see, but it just ran too far to the upside at first. And you see, it looks like you should be able to make some money as the stock's going up over this next couple of weeks. The problem is it's not going up fast enough. So in this case, sometimes these retests work, sometimes it's just too slow. In the case of Tesla, it pulls back around the first Friday in May. We can't get any value for it. We wait for it to bounce. It bounces back to the old high, still trading for like 5 to 10 cents with just a week to go before expiration, and ends up being a wipeout. So that can happen. I tell people, look, you got to go in knowing that You got to be willing to risk that rather than just putting yourself with a 50% stop. Too many times you'll get knocked out of the stop and then it'll go on to its target. So we don't want to do that. The next one here, the signaled all together on the same bar setup here and then confirmed right there at the end of May. That kind of speed of movement that's happening now over the next week is good for the 100, 200, and 300% gain over the course of about maybe 7 or 8 trading days, if I recall. See, it went a little higher. If you wait for the exit, though, here weeks later, you're not only getting out at a lower level, you're losing multiple weeks of time. So part of what we're selling into those upside target profits at 100, 200, and 300% when we can is we want to take advantage of, it's not just that it's worth that intrinsically, it's that there's a time value priced in as well. We're basically willing to say, thanks, you can have ours now that we're up 200 or 300%, you know? So the thought is that it makes it a lot easier. On the downside, it works well in reverse. You can see Schlumberger started breaking down on %R here and then took an extra day to do it on the CCI, but both of them confirmed, and then ADX was a day behind that, and then all three together when we get that sell signal on SLB. We lovingly call it slob, but it's been an amazing stock for us on both sides. We hit it on the upside here at the start of the new year for 100, 200, and 300% profits to kick off 2018. You see the stock was trading about 73 bucks. We're buying an out of the money put. As the stock drops down here over that next week from 73, you see it got to about 70. And that was good for 100 and 200%. And then when it hit up to the first Friday in May, final time stop exit, the stock had bounced a little bit and it was out at like 67% on the last piece. So it's one of those things where it's like, okay, you see it eventually downtrended later, but it took more time. So we need speed of movement. And you see like even this setup here, we weren't quite breaking down on CCI here, so we weren't getting our confirmation yet. I'll show you the bull example on Schlumberger before we're done. Now, when we look at stocks versus options, I like to look at option charts. Why? A price chart of an option will show you how much the time erosion as well as any volatility impact is priced into that option and saying, okay, are we getting a legitimate breakout in the option chart, not just the stock chart? Because you'll see a lot of what look like stock breakouts, and then you go look at the options chart and it shows you that it hasn't broken out yet. So of course, the one thing we don't want to happen when we're buying options is not just to not be wrong, but we even don't want the stock to be flat, saying we're not getting any movement. Your option, if you just sit on it, will expire. So if it's flat or against us after 5 days, we're out to try to get rid of that massive time erosion that happens, especially in those final weeks before expiration. So an example like with Goldman Sachs, I was looking at the stock chart. You see we got a double in like 4 days. And then we had a break even on the second half of the position. That's our final sort of pull the plug point on the second half if we've already gotten to a double. But essentially, that was a 50% gain on the whole trade. Earnings were coming up a week later, but the stock wasn't holding up. And so we had to say bye-bye. Now, if we look at it on the left here on an intraday options chart, because the daily didn't give us enough data, even though you see the uptrend on the daily and the option. This was the 260 calls in November. And you can see that by the time we're, of course, starting to get a %R breakout and such, we're just right around that $1 level. And even here where we get a retest, comes back to like 110 after having been at 140. You say, uh-oh, it was up 40%. Now it's only up 10%. And I say, don't panic. It's still okay. We're still, just a few days into that trade. It's a normal retracement. And then it rockets up the next day, hits our first target at 2. We sell half our position there as we get the $2 fill. It hits to 240. Hindsight's always 20/20, but we can never predict the exact highs or exact lows that a move might make. But you can see that as the CCI and the %R start breaking down here, really ideally, if I was just using the option chart, if it breaks under 160, I should be out, roughly probably closer to 140. But we ended up saying, look, we try to give it the wiggle room and gave it to $1, and then we had to say bye-bye to it when it tags $1. So you can see, though, there's a momentum phase on the way up, and then there's a giving it up phase where it doesn't hold where it should hold that support. As I showed you with Microsoft earlier, you saw this chart. So for sake of time, we got the gap on the earnings. Let's look at the Microsoft options chart. And this is where we bought the Microsoft 80 calls, October 12th, $55 a contract right in here intraday. You can see, got to $1.10. That's our first target here, just over $1. 6 days later, we're selling half at 100%. So the next target we were working is 3 times the 0.55, which was $1.65. I think the high trade here was maybe like $1.40 or $1.45. It never got to $1.65. Notice, though, that %R had broken out. You're getting the continued breakout on the option chart a little bit later in this case. So we felt good that we're retesting back here around $1, and we're holding that dollar retest right before the earnings hit, and then there's our exit right off the open there at 471. So you see it got to $6 intraday, but it actually ended up backing off over the next several weeks. So it was a good exit as well on that piece, up 756%. A couple more examples. Broadcom, you can see AVGO has been in the news a lot for their potential buyout of Qualcomm. This is an example where we got in right here off the open right after a confirmed breakout and all the indicators at the end of the day right there in late October. So we're buying in the start of November, and we're wrong for a day and a half as it pops down 15 points against us. That can happen. Let's face it. You can see by the end of the day, the big trends bands were holding fine. But if you put intraday stops in there, you can say bye-bye down 50%, and then the thing goes on to 100% gain, and then break even on the second piece, so 50% gain. So you go from a 50% loss to a 50% gain. That's a huge 100 percentage point swing in your portfolio. Same thing on the downside. T-Mobile, we just caught that it confirmed the breakdown at that into that Thursday bar close. We got into it on the little bounce on Fridays or some hype about their deal with Sprint, and then Monday morning after we got in, we were selling right in here. We tried to buy 57.5 puts. It wouldn't fill us at $1, so we shifted down to the 55 puts for $70 a contract, and then we basically got the double at $1.40 that next day when it popped from 59 to 55. Okay, so see the inflation that happens as it goes from out of the money to at the money is huge, and that option the remainder we got out at about maybe 50%, and so average maybe like 70% on the whole trade. Southwest, another example. These are ones I'm out of course, because the expiration's long gone. But Southwest was that example I mentioned before where we caught the breakout. And you're going to see on these charts that typically we're not going to be early. It needed to close above that high. It did it the next day. So we're buying in here right in this little retracement. We got the 65 calls out into January in late November. So we got like 6 weeks to go before expiration, maybe 7. And we're saying, look, it's just one of those that just keeps on steadily running to the upside. We get our first double 5 days later, and then 200% 11 days later, 300% hit on that one about December 21st, so or 22nd, right at the peak day before the airlines came cratering back down. Best Buy, again, you see, look at all these breakouts happening. This is on the Thinkorswim chart, so all these breakouts are happening here. The ADX comes in later though, right off of that high, and it closes above it right there. So at the close, we're getting the signal. What we do for our Grand Slam Option subscribers is we send out an entry the next morning. So we'll make it clear that you can take advantage of this and not feel like you're going to miss out by some intraday alert. We'll send it out between 9 and 9:30, right before the market opens Wall Street time. You can see in this one, it then after that entry, it kind of backed off for a day or two, but by the third day, it's up positive. Fourth and fifth day, you're positive versus where we got in. So that's why you stay with the trade. It keeps running to 100, 200. Then the trailing stop got hit 118% in 20 days. So that one was a little longer hold, but you see everything was kind of continuing to trend up. So we're trying to give it a chance. Mylan was interesting because we bought the 42.5 calls and the stock's about 40.5, 2 points out of the money, paid $62 a contract on average. And then we got the 100, 200, and 300% on our 13th day was our final day to hold this trade, January 5th. The first Friday of January. So the way this works is that, we basically focus this option strategy. Simple options buying. We tell you when to get in, when to get out very, very clearly. We do have brokers who can help you get in and out automatically. So if you don't want to fool with it, they can help you with that. You can call us at our 800 Big Trends line to get more details on that. But also, got some more examples too to show you. But essentially, when you look at this, we're saying, okay, we've got a focus list of about 40 plus stocks, really tight list. There's more than 4,000 optionable stocks and ETFs. And so the reality here is that you can really take advantage of this, and then the outlier trend breakouts, the option charts help us see that. Cummins Engine's a case where, I was maybe a little closer to the January expiration here when it was right around Christmas time here, or just after Christmas. Getting the signal, and we needed it to move quickly, and you can see it did in about a week get that double in the first half, and then our trailing stop was hit at about plus 57. That means you average there about 78% on the whole trade in 6 trading days. So you see, you're not going to hold these for a long time. Now, some of the keys to be a Grand Slam option trader, I think the catalyst is so critical. Some of these are technical, a lot of them are technical breakout catalysts for sure. They've got to be to fit our parameters, but usually that earnings has to be good. There has to be some good earnings momentum in there. We'll buy the out-of-the-money options at $1 or less and get that higher gamma where you can really hit that more leveraged home run Grand Slam type of a trade. The time stop is far preferable to the price stop for these more aggressive options. You won't get whipsawed as much. 5 trading days, if the stock's flat or against us, we say bye-bye. 100, 200, 300% on any gap. 5 to 10% of the capital that you allocate for the service should go into each new trade. That way you can start small and then build up. And then I also do weekly video training so you can take advantage of it. Remember I mentioned Schlumberger on the downside earlier. This is one I've been stalking for months. You can see it was stuck at that resistance level. I mentioned it back in mid-September on CNBC World and said energy was my favorite sector, including Schlumberger as one of my favorite stocks, and basically that it was more of a long-term play. It was probably going to take to the end of the year before you really got the true flush out of all the weakness from tax loss selling, et cetera, from energy. But you see, start of the new year right here, first trading day of the new year, we break through that resistance. CCI, ADX, and % are all bull confirmed at that bar's close. So we're in there buying right into this next bar's open, or as it opened up a little bit and then came back down to let us get in. We did not get 280, we got 300 in 5 days. I just didn't update the slide, but 5 days, we got the last 300% target. Schlumberger went even higher and then crashed back down with this February pullback. So when you look at the chart, you'll see it goes up to like 77, and then it craters back down to the mid 60s. So you got to catch it while it's hot, and then you got to know when to say bye-bye and leave it to everybody else. So, you know, we buy them as they're just starting to heat up. When they get really hot, we're lightening up. So basically we're taking advantage of that kind of gradual phase out approach. Now, when we look at the equity curve, if you missed it at the beginning, you can see that starting with a $10,000 portfolio, this is just gross profits and losses, taking all our winners and losers before commissions. You see up 27,500. We're going to average maybe about 6 to 8 trades a month. You know, so over the course of a year, we'd like to get to about almost 100 trades. But the reality is, you know, sometimes it'll be a little less than that. But it's all about quality first, then quantity. When you look at the month-by-month results, February is not official yet, but basically through the end of January, you can see that the total build has been particularly powerful through you know, some really good trending markets. Now, what I'm going to show you is that usually my best offer for my big trends community is that a year of the service would usually be $3,000, and usually I'll take 1,000 off of that and make it $19.95 for a 12-month access. What I'm going to allow you to do as part of this investor inspiration special here is give the chance to try a month for $199, set it up for your convenience and ours as a monthly auto renew. If you don't like it, tell us in the first 30 days it's not for you, and we'll just cancel it. So let me show you how that works here. Let me show you this page here, and then we can see if there's any questions we need to answer here real quick too. Keep on time and on track for all the other speakers as well. Let me show you how to save this extra $200 a month off of the usual $399 price. What this does is it will, when you hit the add to cart button, you can see, by the way, on this page, bigtrends.com/GSO. Thanks, Chris, for posting that. Coupon code is GSO200. So that's the GS and the letter O, then 200. So we don't get confused here. So what you do is when you're ready to go, you look over that page, you just get it set up in your car, you hit the add to cart button, and this is where your coupon code needs to be applied, because if you don't, you're going to pay $399. We want you to save half off here and put the GSO 200 offer. This is our best offer on a monthly subscription. And you hit the apply button, you see there's the code up above. It's been applied. It takes the 200 off here at $199. There's no shipping. Of course, you get instant online access. You also get archive access. You can go back and review past trades, past weekly training videos that I do. My Grand Slam subscribers special strategy session, so you can kind of get all the specific settings. I know I can't give that away for free, but when you become a subscriber, you get all those settings, and just for the meager cost of just starting out for $199 for the first 30 days. You like it, it'll just auto renew 30 days later. You don't like it, just let us know. When you hit the checkout button, we show you how you need to fill out your information in bold. This is for your credit card to process, and then whichever credit card you want to use, Visa, MasterCard, Amex, Discover. And you know, if Chris has helped you today, I appreciate his help being in with us. You can give him credit, or say you saw it on a webinar, Investors Inspiration. This customer note I want to mention, we offer not just real-time email alerts, you can get real-time text alerts at no additional charge from us. Just make sure that you have unlimited texting on your smartphone, because we're going to update you every day about any changes that need to happen right into the market open. So what you do is you say text the alerts to whatever your smartphone is, and then we would ask that you mention what your cell phone plan is. If it's AT&T, if it's Verizon, if it's Sprint, you name it. No preference. It's just that we want to get it on the right batch list to make sure that we can get you your text right away. It speeds up the process for transmission. The terms and conditions are spelled out here in full in this first link in green. I encourage you to review that in full. It shows you also that this is an automatic renewal after 30 days. So if you don't like it, I think you will. I think you'll want to stay with it. We've had a lot of people have been very, very happy. But you can send us an email. You can send us a fax. You can make sure to cancel in the first 30 days, and we won't charge you in the future. So it's very, very clear how that works. Once you review that, hit the terms and conditions checkbox and just hit the submit order button with all your information in there. You should be good to go. If you have questions too, we're here to help. On our order page at the top right corner, you'll see that you can reach us toll free at 1-800-244-8736. If you can't remember that, just remember 800 Big Trends. That gets you to that same number on your phone with 800 Big Trends toll free. You can also email us anytime through clientcare@bigtrends.com. So, you're getting a lot with this Grand Slam 30-day special entry point. Usually, like I said, I've kept it very limited because you can see the kind of names that we'll trade. We can handle, and we do handle often, thousands of contracts going in and out of this. People ask, is that going to affect things on your pricing? And I said, no, because these are very liquid, active stocks and stock options. If they weren't, would not be part of the list. So this is just a sample of some of the gains that we've had. You can see, and as I mentioned, including the Southwest 300%er, the Schlumberger 300%er. Got lots of 200%ers on here on Amgen and AbbVie. AbbVie is an interesting name because basically a lot of people don't follow that. They're not as used to that, but that's one that's been very good in our historic testing. See, we test back 20 years plus. Wherever we have the data, we'll test as far back as we can go to say, where do we have an edge? And that's why these have been handpicked by me to know that they're going to give you your best bang for your buck. I'm also going back and seeing if I've missed any questions that people might have had. If you have questions on the Grand Slam strategy, I'm curious too about the audience about. And so Chuck says, how many losses in that time frame? So yes, we have losses. I mentioned, like when you look at, let's just show you again here for a second, the composite. Go back a few slides. There you go. So you look at, we did have that drawdown in September that was significant. We had, I think, 5 losers in a row right there. I tell people that can happen, and you have to play for that. That can be. It's not all roses, right? There's going to be times where it's like, okay, you're running into some bumps in the road. We try to obviously do everything we can to filter it and minimize it, and try to line everything up so that when we are hitting on all cylinders, we're making a lot more than what we're risking. But you can give back some, and so that's why I'll tell people, start small, get comfortable over a series of trades, seeing what we can do for you. And like I mentioned, some of those brokers can help you to auto trade the recommendations. So if you want more information on auto trading, call that 800 Big Trends number and click through to our sales department or Chris's extension directly. I think it's 730. Basically, that you can actually ask about auto trading, and that way those brokers get you in and out at no additional charge to what they would charge you if you did the trade on their platform yourself. So from that perspective, you have a situation here in which you basically know that you're getting good fills and not having to worry about it, just putting it on that autopilot on a small basis and getting comfortable, making sure you're following all the trades. See, I can't predict which one's going to work and which ones are not. I know that over time, the size of the wins are so much bigger than the size of the average losers that, we can definitely do a tremendous job for our Grand Slam option subscribers. When would this strategy stop working? If you were having to pay ridiculously high volatilities and you weren't getting the directional move, that would be much more of a seller's of options market than a buyer. So we're not there. Like I said, VIX is back down again in the teens. We're getting tremendous directional moves up and down, and you can definitely take advantage of it. Chuck asked, does Thinkorswim auto trade for us? Yes, they're one of the ones that you can take advantage of. And there are others. So call us at 800 Big Trends to get more information on that. But the action point here is go to bigtrends.com/GSO for Grand Slam options. When you use that coupon GSO200 in the add to cart, you can take advantage of that.